Welcome to the first edition of PortfolioFocus. My name's Matthew Zschech, Head of Research and Portfolio Manager. Today I'm here with Dr. Ron Bewley from Woodhall Research, and we're going to talk about the global and the Australian markets and why we're seeing volatility in these markets. We're also going to talk about, well, how is this impacting clients' portfolios? So Ron, why are we seeing so much volatility in the markets at the moment?
Well, we certainly are going through an exceptional phase of volatility, but investors should really be aware there's always volatility in markets, and that's why we get what we call a risk premium. That's why you earn more in equities than in cash, and you have to accept that volatility in order to get the excess return. But the trouble is, volatility comes when you least expect it. It comes in big clusters. So we have a period of calm, followed by a big cluster, followed by a period of calm, and it's when the big times come through, that's when investors get spooked. So what's been happening more recently is we've come out of the slumbers of the post-GFC rally, and what we've seen now is a debate in Congress between Obama and the Republicans which did not get resolved properly. They took it to the wire, and it was like a brinkmanship game about who is going to sort of run the country after the next election. And as it went into the last day, they did seal the deal, but it wasn't the right deal. So Standard & Poor's rated America no longer as AAA but AA+, and that was a slap in the face, and that sent markets into a spin. At the same time, Europe was going through exactly the same discussions but over the Italian and Spanish situation. So we had two stories being played out at the same time, and what we found is that markets just did not know what to do.
So why do we care about S&P? I mean, Standard & Poor's, the rating for the government debt, why does that affect global markets?
It's really a matter of pride, because America has been the country for all of last century. And now, for the first time ever, they're not the best rated country. They're AA+, not AAA. They're not the best. Americans like to win. And in the year before an election, Obama does not want to look like a second-rate country. But importantly, there are two ratings. There's the AAA rating that they lost for long-term debt, and the equivalent AAA rating for short-term debt. On Friday night, S&P took away the AAA rating on the long-term debt, which is more like, what would you call it, a figurehead. The short-term debt, they reaffirmed AAA. So that's why the money markets are happy, because there's no underlying problem. There's no underlying problem in America that will hit them in the next few years. Later on, when the baby boomers get old and need to draw down pensions and sick leave, the baby boomers start to retire next year, the year after, that's when the problems happen. So there's plenty of time for the United States to sort their problems out. But nobody wants to be the first president with not a AAA rating when Australia's got one, Canada's got one, England's got one.
So it's been an absolute roller coaster for people's portfolios out there. Will markets ever recover?
It seems bad at the moment. It seems very bad at the moment, but it's already started to recover. It may fall again later before it gets really up, but markets always recover. There's nothing fundamentally wrong with the world that can't be fixed. People know the answer. It's a question, will the Germans talk to the French, and will they both talk to the Greeks? Will the Republicans talk to the Democrats? That's the problem. It's a lack of communication between different political leaders, and we've even seen it in our own country with a minority government here. Mining taxes, what should we call it? Should we have one? Taken 15 months and we still haven't got it on the table. Carbon taxes. There's so many things that are coming through indecisive governments. This feeds uncertainty into the investors, and the best thing to do when you're uncertain is to bail out first and not last.
So I'm a client, I have a portfolio. It's in the Australian share market. This is your atypical client portfolio. Australian share market, global, they have their own home. What should I be doing now?
Well, in an ideal situation, you would have already done it. And that's the whole point about planning, that you've set yourself up for times like this. If you've been caught short and you don't know really what's going on, sitting tight is probably the best thing to do, providing you're not in a risky situation. For example, I'm 62, I'm semi-retired, all of my superannuation is in equities, and I've got a big margin loan. The first thing I had to address was the risk in my margin loan. I wouldn't want a margin call. So I did that a year ago, 2 years ago, 3 years ago. I saw it all coming, not that the prices would go down now, but if they went down, what would I do? Yeah. And with my super portfolio, I just let it sit. It's going to work itself through. This is just a few weeks of madness, or maybe a few months.
So is it fair to say that balance is what is needed at the moment?
Balance was needed before, but different people have different attitudes to risk. You need some growth assets, otherwise you'll never make any money. You'll never accumulate wealth. But if you have too many growth assets, the volatility takes you up and down.
Yep.
And that's too rocky for most people. By balancing, you only get a little bit of up and down in the whole portfolio, even though you know part of your portfolio is going up and down in wild gyrations.
So, I mean, let's say a client, I mean, should I be selling all of my shares now?
Well, if you sold them on Mad Tuesday, at the bottom of the market had gone down 16% in 5.5 days. The market went up in 7% in the next 4 hours. And then the next day, it went up 2.5% in the next 2 hours. So in 24 hours, the market went up 10%. So if you sold at the bottom, not only did you sell possibly as a loss, you've missed the 10% rally. And nobody can time that rally that perfectly. Nobody can. So you must pre-position yourself so that you can work through these times when they do happen, because they will happen now, they'll happen next year and the year after. If we plan for them, if we expect them, they're a lot easier to deal with.
So Ron, quite often the clients that we see impacted the most at the moment are clients, you know, almost ready to retire, 1 or 2 years away. Or they may be their margin loans. I mean, they may have to sell during extreme points in the market and volatility. I mean, these clients, which are probably the most impacted in the sense that they get pushed out of their investments at a time of not their choosing. You know, I mean, what are your sort of thoughts in that area?
First of all, I feel very sorry for anybody who has to sell, because I had to sell myself on occasion, particularly through the GFC. And because I am now over 60, I want to really distinguish between a geared portfolio and a non-geared superannuation fund. During the GFC, prices fell far more than I anticipated. Therefore, I had to de-risk. It wasn't really selling. It was selling enough of the portfolio so I wouldn't get a margin call. Because if I got a margin call, I'd be close to wiped out. So I had to keep stepping back from the line to say, I must sell now, and that's where you need nerve, but that can be rehearsed before you go into it. Because we know portfolios go up and down, you just don't take it too close to the edge. And I got through the GFC, and because I did it that way, I finished up better off than I was before. But on the other side, for a retiree or a new retiree like myself, is that it's often not as bad as you think, because you don't have to necessarily retire on a given day. And you shouldn't be surprised by the fact that you are 65. You knew 5 years before. So if you think you want to retire at a certain point in time, then you glide into it by actually adjusting your portfolio if that's your risk attitude. And if you're going to be alive for a long time, and I hope we all are, it might be 30 years in retirement. So where are you going to grow your assets from? So although one can be old and happy in equities, it can be for a very long time, and therefore a blip like this of a month or two feels bad, but it will work itself out over the course of your investments. Just make sure you have enough dividend payments or interest payments from your term deposit to live on. Those are basic. And then the extra comes from the equities, and without the growth assets, you may not have enough money when you're 80, and it's a decision, do you want it when you're 60 or when you're 80? You want both, but it's a balance between the two.
Well, that closes our first edition of Portfolio Focus. I'd like to thank Dr. Ron Bewley from Woodhull Research. Ron, that's an invaluable insight into, you know, what we're seeing in the volatile markets at the moment. The key things that I took out of this session was, one, is to have a plan. The plan is everything. I mean, really take the time to go and see your financial planner, get good advice, and really look through this market volatility.